As the saying goes, what goes up must come down, right? That's how some investors are thinking about the US stock market these days. The S&P 500 index is near its priciest levels in history, and a laundry list of troubles threatens to end its bull run. So how can investors thrive at a time when doubts are creeping in? This veteran growth investor is here to share his top rules for prospering through those tough times. You're watching Inside Investing. Hello everyone, and welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspectives from savvy DIY investors and financial pros. I'm your host, Hiran Amin, filling in for Rob Moisey, and I'm really excited for today's conversation. It's often said that when success or preparation meets opportunity, that's what success is. And there's sure to be plenty of opportunities in uncertain markets. Well, our guest speaker has a whopping 72 rules he invests by, so you know he's prepared for anything. Joining us is Robin Speziale, a DIY investor with over 20 years of experience under his belt. He's the author of not one, not two, but 4 books on investing, including Market Masters in 2016 and Capital Compounders in 2018. And he's also the host of the same namesake, Capital Compounders podcast on YouTube. Robin, it's great to have you with us, and thank you for taking the time to chat.
Hiran, thank you very much. It's a pleasure being here.
Robin, I want to start off by saying, did I get your name right first?
You did. That was spot on, so thank you for that.
All right, let's get to know a little bit about you, Robin, first of all. I'm intrigued by Capital Compounders, that term. You've coined your book, Capital Compounders. How did you land on that term, and what does it mean?
Yeah, so as a do-it-yourself investor, what I look for are just wonderful businesses where the founder, CEOs, for the most part, I like to look for founder-led companies. They're really good stewards of capital and growth capital at that. So these are companies that are high revenue growth, free cash flow generative. The free cash flow they generate, you have the best capital allocators at the helm of those companies that can take that free cash flow, they can invest it back in the business, and then you get this very high return on capital as a result that benefits shareholders in the long term. Okay.
And you've been at this for a while now, Robin, right? So, I think you started at the ripe age of 18 years old. You didn't come with any sort of fancy degrees or accreditation at the time. You were a self-taught investor, reading over 50 books, if I have that right. So if I could tell you to go back to your 18-year-old self, or think of it even for today's newer investor, if I would ask you only 3 non-negotiable rules from your 72 rules for building wealth through growth stocks, what would they be and why?
Even further back, if I can go to a story, actually, it was my grade 10 teacher who, at the start of class, she put the business section of each newspaper on our desks, and she said, okay, pick a stock. So each of the students, all 30 of us, were to pick one stock. My stock was Fortzani Group. So that was my foray into growth investing. Fortzani was eventually acquired by Canadian Tire. But it was a founder-led company. He had a lot of grit, a lot of ambition to grow the company, sport checks across Canada. That was my foray. But then going back to your question, the 3 core principles essentially is growth at a reasonable price. So I want to buy into wonderful businesses at a fair price. Because if you're looking at value investors out there today, a lot of stocks are cheap and cheap for a reason. So if I can buy into a wonderful company at a fair price, then I'm happy. Growth at a reasonable price. Secondly, concentration. I run a concentrated portfolio of US and Canadian stocks. I want to concentrate on my best ideas. If they're not among my best ideas, I don't want to invest. If they go through trouble that's systemic and there's no turning around, then I divest that company and I put it into my next best idea. Thirdly, psychology. It's all about mindset. We're going to go through corrections, bear markets, major drawdowns through recessions. And it's having the mindset to actually stick it through, to stay invested. It's not timing the market. It's time in the market, and we can actually reap the gains from capital returns from each of your companies.
Yeah, that seems to be like the mantra that most investors live by, time in the market. Now, I want to ask you this, because being a stock picker, it's notoriously difficult to beat the broader market. A lot of people would say just index and avoid the stress, or index and chill is what the saying goes with the young kids these days. But you've managed to do it on a consistent basis through your investing career. Why do you think you've been so successful through those market ups and downs?
Yeah, so if you were to ask any of the Forbes 500, let's say billionaires, multimillionaires, no one would ever tell you from the Forbes list that I got rich investing in an index, investing in an ETF. It's really a big concentrated bets in a small number of companies. So I think that the reason why I've been successful is that I'm not completely correlated to the index or to the broader market. 80% of my capital is actually invested in the Canadian market, whereas 20% is in the US, predominantly the S&P 500 companies, but in the tech space. So concentration there has led to outperformance. Concentration in Canada, that 80%, has been among the micro, small cap, and mid cap space, which is highly uncorrelated to the S&P 500. So while the index has achieved, let's say, 10%, including dividends, of annual returns every year, what I strive for is 15% annual gains. Okay. Striving for anything above, I find, there's always pockets for failure. 15% for me is my sweet spot.
That's your Kager, okay. Yeah. You started, as you said, 18 years old. I think you out of your Waterloo dorm with
That's
10K.
Right.
I think by 30 you were at 300K, but you had aspirations to hit that magic $1 million marker by the age of 35. So let's do a check-in. So did you hit that seven-figure number by 35?
I made it. So I'm happy to say I did make it. Yeah.
Okay, fantastic. So now what we're going to do, before we get into the crux of our interview today, let's get into your approach for investing in growth stocks in a market where some investors might worry about overvaluation. And for those in our audience, for questions for Robin, make sure you submit your questions to us. If you're watching on WebBroker, use the chat box to send your questions to us. If you're on our broadcast platform, use the question and comments box on the right side of your screen. And for our viewers on YouTube, click on the link in the description to hop onto our broadcast platform and find them in the Q&A box. All right, Robin, let's get back to it. And the main theme that I wanted to start with is on overvaluation. This has been an ongoing debate for the last couple of years. So let me ask you bluntly, do you think the Canadian and US markets are overvalued today?
That's really hard to say. And I'm not a predictor at all. I don't have that crystal ball to say that, yes, we are overvalued or undervalued or fair market value. If one were to look at the Shiller PE ratio, which is basically the price of the index divided into past 10 years of inflation-adjusted earnings, we are at about 40 Shiller PE right now. I believe it was 45 when the dotcom bubble happened. It was around 30 when the financial crisis happened, 2007-8. And while history doesn't necessarily repeat perfectly, it does rhyme.
It does rhyme?
Yes, and the drawdowns don't always look the same, and they're not always drawn down to the same magnitude. So by having an uncorrelated portfolio with 80% of my money here in Canada, and again in micro, small, mid-cap companies, I'm almost insulated in a sense because I run a concentrated portfolio. I'm following each company quarter by quarter by quarter, and if there are any, if there's execution risk or actual execution failure issues, then I can take control of the portfolio quickly there. So I'm not so exposed to the overvaluation of the broader market or index, nor am I too worried. But that opens up opportunity. So when corrections happen, of which correction happens every year. Let's face it, 10% drawdown. It's not so rare anymore. Yeah. When the broader market is affected, you can plow more money into your
it's a
best
reset.
ideas.
It's a healthy,
exactly. It's healthy.
A healthy reset. Absolutely. For a bull market, right?
Yeah.
Yeah. So let me ask you this, because most investors want to take a top-down view. Granted, you are very concentrated in your position. Mm-hmm. Is there, if you kind of want to read the tea leaves, do you look at sort of any indicators or markers? We talked about PE, the Cape-Shiller ratio, mm-hmm. but do you look at anything outside of that that just kind of gives you those clues?
Honestly, it's a little bit of intuition, and it's also about reading the market. And sensing where everybody else is at. There's that story about, I think it was JFK's dad, Joseph Kennedy, mm-hmm. and the shoeshine boy, right? Joseph Kennedy would say, as soon as you hear the shoeshine boy or like the barber talk about stocks or the market, how they're getting rich, usually this is a time where you have to really rethink your exposure to the market. While I say that, I've always been invested in the stock market. I think it's the greatest wealth creation tools ever invented and available to us today. But my gauge is Uber drivers. As soon as I hear Uber drivers talking about the hot stock in 2018-19, it was all the cannabis stocks.
Yeah.
I had Uber drivers just talking about it all the time. I thought, wasn't the basis of my decision, but it was one of the factors for actually selling out of canopy growth. And
if it permeates there, later. Then you want to worry. What's the similar story was like, when your cabbie starts talking about stocks, that's when it's time to get out.
Exactly.
Okay, so let's say, you've got the sense that the broader stock market is overvalued. Do any of your rules out of the 72 that you have help you minimize the risk and take advantage of the situation?
Yeah, so I don't hedge. I keep money on the sideline, and I do have a little bit of margin as well. It's almost an opportunity fund to take advantage of any drawdowns. I don't short the market either. I honestly don't think I'm smart enough to short the market. And of course, there's borrowing costs as well when you get the smaller companies that eat into potential profit. But yeah, so my mantra is just to really understand those businesses well, keep on investing in those leading businesses, and really keep an eye out on any issues that may arise as well, so you can pivot quickly.
Okay. You're big on growth stocks.
Yes.
Okay, so these are notorious for having high price to earnings ratios, right? Whether you look at it from a trailing basis or even from a forward basis as well. So if I were to ask you, is there certain levels you look at on those stocks that just say like, hey, I would not touch this if it hit a PE of this, just regardless of what kind of the bones are behind, the curtains?
So that would be first level. Like how I started, I would say, hey, like it's 25 price to earnings ratio, that's too high. But then I quickly learned you have to look at the growth, future growth. It's all about that. So it's not the PE ratio, it's the price to earnings growth ratio. Yep. So while the price to earnings can be 25, but the company's growing at 40% revenue, 40% earnings growth, 40% return on equity, then this is a company that I typically invest in.
This is a PEG ratio you're talking about,
precisely,
Robin? Okay.
Exactly. Yeah.
Okay. All right, so that's one to keep an eye on. We'll chat about that as we get into the meat of it there. Now let's talk about volatility as well, because we've been experiencing that. There's a ton of price volatility. The stuff that can keep you awake at night, and especially with the economy, what's happening on the backdrop, the geopolitical front as well. So how do you stop yourself from hitting the sell button prematurely, or even conversely, if I were to say, getting caught up in the headlines and holding it too long?
Absolutely. So I minimize all noise. While I'm up to date on BNN, on CNBC, Market Call, the show as well, I try to minimize as much noise as possible, of course. It's just all about holding and continuing, to water those wonderful companies. You have to trim the weeds once in a while, as Peter Lynch would say. Yeah. But that's really the name of the game.
Okay.
Yeah.
All right, so I think we're going to move into sort of our next segment over here. We're going to talk more about the actual numbers themselves. But before we do that, I just want to have a question for our viewers. Are you enjoying the show so far? If you are, then please be sure to give us a follow on TD Direct Investing's YouTube channel, Instagram, and Facebook to get a sneak peek at upcoming episodes and a ton of other content designed to help build your investing knowledge. So let's talk about the golden rules for your growth investing now, Robin. So let's get into the actual approach that you have, that for stocks that you feel that will have significant upside, dare I even say what you would call multi-baggers that we have in the cards, okay? So you have different philosophies when it comes to investing in Canada versus the USA. So talk me through your rationale behind that.
Absolutely. So my rationale for the US is the following. It's that book 0 to 1 by Peter Thiel, right? Because in the US, you can find these near monopoly companies that are growing, gobbling up other companies as they go. So like Alphabet, Amazon, and the like, NVIDIA. And these are companies that are seemingly defying the law of large numbers, right? And what I find with US companies, because you have so much organic growth and you have hyperscalability in the US and abroad internationally, you can just basically pick the winners, the leaders in US stocks. That doesn't really apply so much to the Canadian market, but again, this leads to an advantage for Canadian investors in Canada. So while it's tougher to invest in large companies in Canada, because once a company gets so big in Canada, you have American companies looking and saying, hey, we want to outcompete that company, like Apple and BlackBerry, huge market to capture. Or as soon as those companies get large, they seemingly get acquired, private equity comes into play. So the sweet spot for me in Canada are really those micro, small, mid-cap companies. Those that a lot of mutual funds ignore, Americans ignore when they're looking at stocks. And those are companies that you can never find in a screen.
The unloved companies.
Exactly. Okay. The unloved companies that you can't run a screen of ROE that's 40% or higher, because you're going to miss a lot of these wonderful small companies that might not be generating profit right now, but there's a path of profitability. Okay.
Well, let me ask you this then, because I think on the other side of that, when you think about our two markets and the dynamics of it, Canadian markets have a reputation for being too concentrated amongst a couple of just sectors. You're talking about energy, we're ruled by miners and financials, but you don't have a lot of new entrants into the financial space. So you're really looking at energy and miners. So is this kind of where the hunting grounds are going to be concentrated, in those spaces?
So the hunting ground for me is if you remove all financial services, if you remove all of utilities, if you remove all of real estate, junior oil and gas, mining. That leaves everything else. That leaves technology. That leaves consumer brands and some retail and healthcare. That's the hunting ground for me, and that's where I like to look. And when I go to cdar.com, that for me is a prime hunting ground because it's almost an informational advantage. It used to be an even worse interface, cdar.com, but again, because it was not inviting at all, it almost made it easier for me to go into the stock picker and just pick and choose, look up company releases, your quarterly reports. They have improved cdar.com, but it's still not very intuitive to use until this very day.
So let's jump on that for a little bit because your focus is on these multi-baggers, small and mid-cap spaces where you are. So what's sort of the ideal Canadian growth stock and that could suggest it's a multi-bagger? What sort of features are you looking for to start with?
Absolutely. Okay, so back in 2014, so 10 plus years ago, there was a small company called Constellation Software. And what I find the most outperforming companies, some of them, there's a crop of them in Canada, are what I call serial acquirers. So Constellation Software, MTY Food Group, and there's others as well that have just outperformed the market over time. Now, Constellation Software in 2014, that was admittedly a screen, and I screened for any stock over return on equity of 20% or higher. Yep. Constellation Software popped up. I had never heard of it, went onto the website, and it was basically as archaically a website as Berkshire Hathaway was. It was very basic HTML. Looks like a high school intern coded it. But the beauty and the magic was in the execution of Constellation Software. Founder led by Mark Leonard. The numbers were phenomenal. He was hyper fixated on return on equity, and again, deploying that free cash flow in a very smart and effective way to basically have the highest return on capital in the industry. And that company is still successful today. Mark Leonard did step down because of health concerns. Right. But there are some factors, and this leads into what to look for after you invest. With Constellation Software, it's the founder and CEO, who is one of the best in the world, stepping down. Then it's the threat from AI, right? So the crop of companies they have, the vertically integrated software companies, will AI be eating into that
disrupting them businesses?
Right? Exactly. And then thirdly, it's Constellation Software, because of its size, they have to be hunting for larger and larger acquisitions, and those are harder to come by. And there's tougher hurdles to get over to contribute to that increasingly high hurdle rate of that return on capital. Yeah.
So what I'm hearing is obviously founder-led companies, management possibly has skin in the game, I would say. But something that perked my ears just a moment ago, what you said was you don't like using screener tools. You like really diving into CDAR. So maybe for our folks, just talk me through that. What information is CDAR giving you that maybe a screener wouldn't, and what are you looking for in there?
Absolutely. So with a company like Well Health Technologies, Hamed Shabazi, it's a founder-led company. It's fantastic. Telehealth, they're buying up. They're serial acquirer of clinics throughout Canada, and he has a very laser-focused vision for health in Canada as well. That was a company that you couldn't find in a screen because it was not profitable at the time. I couldn't just look up return on equity. It was just me every single day, not just going through CDAR and looking at company filings. It was actually the quarterly report they issued, and I thought, I've never heard of Well Health Technologies. I looked into the report. I thought, okay, this is a company I'll put on my watch list. I'll look later, and I wanted to wait for that path to profitability. Every day as well, I look at top gainers. I look at the top gainers in the TSX. And stocks that are reaching their 52-week highs. Okay. So while you have to be very conscious of not buying overvalued companies, obviously you want to be buying companies that are
market's voting with the dollars, right?
Exactly, and that's reflecting in stock price appreciation. So that also catches my interest too, and those are sources of knowledge for me.
It's very interesting you bring that up because when you have stocks that are so small, like in the micro space, small cap, the street isn't really covering them, to your point, right? So you're not having that information in analyst reports or anything. So as you said, you're really going into the weeds there, and I don't know if it's Excel sheets or anything. You're diving through the numbers. Obviously, not everyone's bread and butter, but certainly that's where the good nuggets are found. I guess.
It's the treasure hunt.
Yeah, exactly. It's the treasure hunt experience there. Now, to oppose that, though, this is obviously the small and mid-cap space. Yep. You do, however, like running screens on larger cap companies, of course. So what are some of your favorite metrics you like for spotting these growth stocks?
Absolutely. So FinViz is a website I do like to go on. When I do screen for U.S. companies, it's starting with revenue growth. You still want to see that top-line revenue growth. You want new revenue opportunities. It's not just a company that keeps on cutting costs and they're boosting profitability via that way. Then you want high earnings as well, growth. and then you want that return on equity. But then a step further is return on invested capital. When you go a step further to ROIC, return on capital, you re-add in that debt into the denominator.
Okay.
So if a company is misusing debt, if they're heavily debt laden, you can see that in the return on capital. It'll come down from that return on equity figure. For example, Valiant Pharmaceuticals. They were a serial acquirer, but the debt kept on piling and piling and piling. So while return on equity was high, if you look at return on capital, it was actually quite low. So you really have to dig in. So second and third level of research.
So you want those two sort of complementing each other, they should sync each other. If one's saying the other, then that's probably... So actually, let's talk about red flags, because that's what I wanted to get to next. What are some red flags that you have when you're spotting these growth stocks that would make you say, I'm going to take a step back on this one?
Too much debt, as I said.
Okay.
And then with the example of Constellation Software, since their inception, their IPO on the public market, Constellation Software has not once issued one new share. So their share count has been the same since IPO. Companies that dilute shareholders, they'll basically use shares as currency to grow. You have to be very careful. So debt, share dilution, and if the CEO gets on a quarterly call and blames company performance on the external factors that are just so generic and it has you scratching your head, like there's also a sniff test. You have to use your intuition, and then you just match that with the numbers. Right? So if you originally invest in a company that, okay, this is a company that's growing at 20% per year, but if 5 years later they're only growing at 5%, well, you could just as well buy Walmart, right? So you divest of that company, and then you just keep on with your best ideas only in your concentrated portfolio.
Okay. So obviously we talked a little bit about this at the start, but you've openly talked about riding like the Amazon style, the 50 to 75% drawdowns, because the underlying trajectory was still upward on the stock itself. So walk us through maybe a time in your own portfolio when you had to stomach this kind of volatility on a growth stock, and how did you not sell?
Absolutely.
That's a big thing.
So I broke a rule, a general rule: never buy a stock on IPO. I did it with Shopify. And I did it at $25 a share, and now it's something close to $200 a share. But Shopify, since its IPO, has gone through several drawdowns. But you really have to, have your conviction, and it's easy to keep conviction when, again, still a founder-led company by Tobias Luque. They're still growing at a high exponential rate, and the vision is just so phenomenal. They're basically the platform for entrepreneurs and solopreneurs around the world, e-commerce, and even big e-commerce brands, right? They go to Shopify basically for that infrastructure and that platform. And that's a company where I have ridden out the drawdowns. It was down, I think, right after the pandemic. When so many entrepreneurs are starting up these small shops, right, selling the dog things, and
there's a heyday back then for Shopify, right?
The drawdown was about 80% post-pandemic. When a lot of these people who were out of work or they wanted a side gig, they basically stopped selling their goods through Shopify, and the stock was down. I was actually adding near the bottom.
Okay.
I still very much believe in the vision. They're powering these smaller entrepreneurs and even large companies as well around the world. Yeah.
Okay. That's a great one. So let me follow up that. That's in a case where it kind of checks off the boxes you had. You kind of walk through the price volatility in that. What would give you pause to actually say that I am going to sell the growth stock? What would you want to see? I know you mentioned a little bit about deterioration in the earnings growth.
Yes.
But I'm assuming that's one of them. But any other things you'd look at?
Deterioration in earnings growth. If there is a new CEO that I've looked into, I don't very much believe in their vision, then I will consider selling as well. If there's ever an issue with your customer concentration, when it comes to micro, small, mid-cap companies, you have to be very careful about understanding how concentrated is a customer portfolio. If they have only 3 customers and they lose one, that's a third of their business. And a third or more of the stock will just basically craters. You have to be hyper aware of that.
And you find that right now in the markets when you think about some of the AI space, the hyperscalers. There's talks about the circular financing. Everyone's like lining up each other's pockets, and it's just like, I don't know, is it built on a house of cards, almost to say. But there's one other thing I want to talk to you, because you led with founders quite a bit, and I wanted to ask you, when you do have this shift in founders, or there's a change of management, I know we talked about having skin in the game. How do you make that assessment now when a new management steps into place to steer the ship?
Skin in the game is so important. And I use a site called Market Screener. You can go on the site, type in any public company, and I can show you the top insider holders of that company's stock. I want to see that the entire management, especially the founder and CEO, has skin in the game. They have a percentage stake in the business. 5-10% is really prime. Even the CFO, CEO, all the way down, the whole management has that. And it's also important to keep track of insider sells. And you can find that as well on Market Screener, all for free. So if there's insider sells happening, usually that could be a leading indicator that something's going on with the company. I love to see insider buys. I love to see conviction internally that the management very much believes in the business and that they are continually buying shares.
Okay, excellent. Yep. And I'll just say this for our viewers who are on Webbroker as well. We do have an insider report you can find on a lot of these stocks, Canadian and US. So that's another place you could check out for insider buying and selling activity there. We're close. The time is upon us close where we're going to get to our Q&A in just a few moments' time. So please, if you haven't got your questions in, go ahead and get them in. Remember, on our broadcast platform, enter them in the question and comments box. If you're on YouTube, click the link and jump in, and you'll be able to fire them in that broadcast platform. But before we do that, I wanted to bring in my colleague, Caitlin Cormier, to show us how to take what we've heard from Robin today and how you can get started with your stock research on Webbroker. Caitlin, how are you doing?
Doing good. Nice to see you here, Aaron.
Great to see you again as well. So, me and Robin, we chatted quite a bit about some few different metrics that we have. So maybe for our viewers, how could investors really narrow down their list of stocks to consider using some of the fundamental metrics that we talked about today?
Yeah, absolutely. So one of the things that was mentioned, and maybe not kind of key for Robin, but one that can be used is a screener tool. And we do have one right within Webbroker. So if we want to just hop into the platform here and take a look, in order to get to this tool, we're going to come under Research. We're going to click under Tools and click on Screeners. And then I've selected the Screening button where we can actually select our own criteria in order to find specific companies. We can go ahead and, select an exchange if we want to choose just Canadian stocks. And then there's a whole bunch of more criteria that we can choose from here. There's a big list. I've actually gone ahead and taken some of the things that we talked about today and created a saved list. So what I have here is I have a specific sector and industry. We've got healthcare and technology. We've also went a little more narrow on our market capitalization. We have kind of between 100 million and 10 billion. We have a current ratio over 0.5%, and we have earnings per share growth over 20%. So once we have all of that in there, it's actually going to spit out 54 different stocks that meet that criteria. Now, this is Canada, US, so we can narrow it down even further. Maybe we'll put it back because we only had 3 results. So if we want to look at the 54 results, we can just scroll down here and see those companies that match the criteria. And we can see the specifics as to how they match the criteria. And if we click on them, of course, it'll show us where they kind of fall within the range of the rest of the results.
Okay, perfect. Thank you so much, Caitlin. I almost see like when you're creating this list, you're almost narrowing down your dating list of stocks that you have. But then you also want to get the friend's opinion, And so in this case, when you're coming with stocks, what I consider analysts, what are their perspectives and commentary that they have? And they may even give you some of those numbers that we don't necessarily get through the screener. So is there a way we could go about doing that?
Yeah, absolutely. I love that analogy. That's great. So, of course, the place that we can go to get that second opinion, especially an expert second opinion, would be reports. So, again, if we want to hop into the platform, we can click on the Research tab. Now, in this case, we just go under the stocks, and I already have CSU brought up as a stock, one that we did talk about today. In order to get to the reports, probably self-explanatory. We're going to click on just the Reports tab here towards the middle of the screen. Once we click there, it is going to show us a number of reports, including the insider report, as we just mentioned a moment ago. But the 2 that I wanted to look at today are these 2 at the bottom, the Morningstar Quant report and the Analyst report. So I have them listed here. The first one that I have here is the Quant report. And this particular report, if we just scroll down a little bit, we can see things like the free cash flow is available in here with as well as the return on invested capital. So lots of different numbers here, some visual representation and really good analysis of the companies. And then finally, the other report here is the analyst report. And again, we're getting a whole bunch of information about this company, lots of commentary, bull and bear kind of opinions on it, and all that sort of thing. So kind of a large report, but it does have a lot of information in here, certainly over time as well.
Thanks, Caitlin. That was TD Direct Investing Senior Client Education Instructor, Caitlin Cormier. All right, so Robin, we are upon that time. We're going to open up the floor and start taking questions from our viewers. I believe the first question that we have, this one is coming from Neil. Neil's asking, do your stock picks need to meet all 72 of your rules before you make a purchase? Those are a lot of rules, Neil. Sorry, Robin. But go ahead. Are you using every as a criteria checkbox there?
So Neil, thanks for the question. It's a great question, and the answer is no, basically, right? Like it's all about picking and choosing what works well in that situation for that company. The rules are meant as guiding principles, but if you can check off 71 but not 72, it doesn't mean that you don't invest in the company. Yeah.
Okay. Do you have, Robin, if I were to ask you, do you have like a phase-wise, like, hey, I got to hit these rules first, and then if they check out on that, I move to the next set of rules now? Yeah,
so there's a science to it, but at the very end, there's an art. And the art, the final decision making before I pull the trigger to actually buy into a company or increase my stake is I continually ask myself, if this company were to go away, would anybody care? If the answer is people wouldn't care if the company goes away, then it's really not a good company to invest in. If Amazon went away, everybody would care. They'd say, "What's going on? I can't access the website. I can't go buy
shopping
things.
box on my porch. Where do I go now?"
Exactly. Yeah. And so that's really the question I ask myself. If no one will care if the company goes away, I'm not going to invest in the company. That's the last question I ask myself.
Okay.
Yeah.
All right. We got the next question here. This one's coming from Roger. He's asking, with Canada's high tax rates, what makes small and mid-cap companies attractive investments? That's a very good question.
That's a great question. So while there's a lot of great companies, wonderful businesses to invest in Canada now, we're just not seeing the same activity in the IPO market on the TSX and the TSX Venture like we did 5, 10, 15 years ago. I really hope that comes back. And that'll be, a big factor will be from the government, the federal government, the corporate tax rate, and of course, provincial governments as well. And I really hope we do get a pro-business government in place, or the current government. I hope they do turn more pro-business. That would be phenomenal.
So when the IPO well does dry up, do you ever find yourself turning over to south of the border and seeing if there's any opportunities out there?
Absolutely, yeah. There's always opportunities. There's always a healthy IPO market in the U.S., but there is also a very good crop of good, wonderful businesses here in Canada. That because I run a concentrated portfolio, I'm not always looking for new ideas all the time. A mistake that I see a lot of new investors make is that as soon as the IPO market heats up, they just keep on buying and buying and buying more new stocks, and their portfolio balloons to like 50 or like 100 stocks in their portfolio.
Yeah, you get caught in the frenzy, and you've got like unbearable amount of stocks that you got to deal with now.
Exactly. So the key is really to concentrate your bet. Even Warren Buffett throughout his career, if you look at Geico, if you look at Apple more recently, he's had 50 to 60 to 70% of his capital at times invested in one company in the portfolio. Right. So concentration really, in my mind, is what leads to the greatest success.
We should bring you back for a debate whether diversification is actually really needed. Okay, so we got our next question here. This one's coming from Chris. He says, how do you use analyst ratings in your investment decisions? You said you cut out the noise on headlines.
Yes.
But where does this factor in there?
I don't. I don't look to analysts because, again, going back to the point, they don't have skin in the game.
Yeah.
Who I do look to are the hedge fund managers, the mutual fund managers, the money managers across North America who have skin in the game. I look at what they're holding, what they're buying into, what companies they're talking about, because again, they are allocating capital to those companies. Analysts, not so much, right? Like a buy and sell rating doesn't mean so much to me. I do sometimes look at their research reports. There are some phenomenally good analysts out there. There's a lot at TD, for example, and they write some really good research reports, and I can use that to augment my own research.
Just to complement, what you're thinking, if it falls in line with it, absolutely. Yep. Okay, we've got our next question. This one's coming from Melanie. She says, how do you feel about investing in ETFs? Oh, you're a stock picker, so what's your view on this one?
Melanie, how are you doing? So I only started dipping my toes into the market, and not in a big way, only because I had my daughter a year and a half ago. Okay. And I do own the Vanguard VOO, which follows the S&P 500.
S&P and chill?
Exactly, S&P and chill. So I have broken my rule. I'm still very much a stock picker for myself. Yeah. But for her RESP, all of that money annually goes into VOO.
Okay, well, there you have it. We've got our next question. This one's coming from Carolyn. says, Robin, you mentioned looking at stocks near their 52-week highs. Can you elaborate? Is this a factor in your buy decisions? And this is interesting, Robin, because we had another guest like a couple of years ago who's also into the small and mid cap, but they look for more depressed prices to see if at the lows before there's an opportunity on the upside. So you're on the opposite side of the spectrum.
I'm on the opposite side of the spectrum, exactly. A value investor would look at the 52-week low.
Yeah.
Again, like so many examples of cheap can get cheaper, right? Like it's cheap for a reason. I like to look for companies that are, again, they're making new highs in their own stock price.
Okay.
And usually something is going right in that company. When it's a parabolic rise, let's say the company's gone up 100%, 200%, 300% in a week, I avoid those, pump situations.
Right.
The fundamentals have to always be there where I get really interested in that company making new 52-week highs. Because earnings and revenue and everything else have to always grow into the stock price. Parabolic moves, I stay clear.
Yeah.
Usually when it's a parabolic move up, it's a parabolic move down.
You get those V-shaped corrections
Yes.
when the price detaches from the fundamentals completely.
Exactly.
So absolutely key to look at. Next question we got, this one's coming from Carolyn. Carolyn's saying small and mid-cap stocks often have low volume. It's a liquidity issue. That is a very valid concern.
Yes.
And limited momentum as well. So how do you approach these challenges? And maybe you're probably, you're sizing in stepwise to getting into them.
Absolutely. Liquidity is a concern. And if your hedge fund manager is a concern if you want to ever sell down your stake, because it can be quite hard to sell illiquid companies. But what I like to do, there's a metric, and I'm sure you can find it on a web broker, it's called accumulation distribution. What you want to find is that as the price of the share goes up, as years go on, you're getting that volume support. So accumulation distribution, it shows relative to the price appreciation, that volume appreciation too. And you always want to see those married and in tandem.
Yeah, you're talking my language now, Robin. I'm a technician at heart, so I look. We look for volume, and we to corroborate the story that's happening with market voting.
Absolutely.
For the dollars there. All right, I think we've got another question here. This is from Matt. What was the biggest investing mistake you've made, and what did you learn from it?
I love this question, Matt, and thanks for asking it. So it was probably a year after investing in my dorm room, probably a year or two at Waterloo. I invested in a company called London Mining. And it was my first and only foray.
London, look with a U.
London, L-U,
okay, I remember that name.
N-D-I-N.
Yeah.
London, I think it was a Swedish heritage founder. And it was the only time I invested in mining. And all mining stocks just faced the largest drawdown probably ever after the Chinese stopped gobbling up so many commodities. It was right around the time of the peak during the financial crisis, so 2007, 8, 9, it all came crashing down. I believe I lost 90% of my maybe $1,000 I had in London mining. But I have not gone back to mining since. Okay. And this is just going back to core principles of Peter Lynch and Warren Buffett and the other successful investors, buying what you know. And that's what I continually do today.
You got to understand the business that you're investing in, how it makes money, right? Those are the fundamentals of it there. Okay, so we've got our next question. This is from Dave. Are you leaning on technical indicators or studies more frequently in an overvalued market? I'm curious to know about this because I know you're very much a fundamentals guy, but do you turn to that as well to then make the decision to make the buy or to sell? Yeah,
so in an overvalued market, I look at it at a micro level. So I look at each of the company's portfolio, and I like to use 50 and 200-day moving averages. I do. Okay. So accumulation distribution, then 50 and 200-day. Because when a stock price overshoots, like way over the 50 and 200, usually stocks will revert to their mean. It's just the way it goes. And so what that does for me, it doesn't mean I'm going to sell out of that company based on that technical indicator. It means I wait for that opportune time to start adding more capital to that company, as long as it continues to execute. So there's people who say, I never use technical indicators. Well, I'm not that person. I love to use it. It's part of my tool belt. Yeah.
We're singing from the same choir there, Robin. I always say you want to look for fundamentally great companies at technically great prices. And that's where you turn to the charts.
I subscribe to that.
Okay. All right, we've got, I think we're almost at time, so we're going to get the last question fired here. This one's coming from Lynn. How many stocks do you hold in your portfolio at one time? Okay, so right now and for years, because I'm a concentrated investor, I only invest in my best ideas. 10 stocks in my US portfolio, 10 stocks in my Canadian portfolio. And my average holding period now is it's between 5 to 7 years of each company. There are exceptions. For example,
in NVIDIA I've held for many years, over 10 years. And what's interesting about investing and it being an art is that my thesis when I first bought into NVIDIA wasn't because of AI. It was because of the video gaming. Exactly.
Yeah.
The video gaming prowess.
That's how I started mine.
Exactly. They were the chip provider for all the consoles like Nintendo and the like. And so you really have to adapt as well. You know, if you were to sell Apple stock and say like I'm out of this during the Mac PC era, you'd have missed that entire S-curve when the internet came, when mobile phones came, when the tablet came, when this big ecosystem of applications came with Apple. So you really have to adapt, and you can't just anchor yourself in what the company used to be. So it's all about keeping up to date.
Yeah, Apple had that inflection point once they came out with the iPhones. It was a game changer that kind of absolutely shredded the BlackBerry's market at that time, right? So that's great to hear and fantastic. And I think that's it for us, Robin. You know, we're going to have to leave it there. You know, thank you so much for sharing your approach to growth investing. Hopefully, some of these rules have kind of rubbed off on some of our viewers, and maybe they can incorporate in some of their own stock picking for anyone who is watching. And for those in our audience, thank you so much for tuning in. Make sure to check out next week's episode. Bipin Rai from BMO will be here to explain how equal weight ETFs can help investors protect their portfolio concerns about overvaluation in the S&P 500 index. That's all the time we have for this edition. From everyone here at Inside Investing, thanks again for tuning in, and we'll see you next time.
Have more questions? Check out the links to the right and in the description below.